Today's company is a surprisingly less known 188-year-old company with a very impressive track record. Over the decades, they could reinvent themselves several times, and today they still beat the market on a regular basis. Over the last 10 years, for example, they could deliver returns of over 300% to their investors, and this year they were being nominated as the world's most sustainable company by Times Magazine. I am talking about Schneider Electric. They are market leaders in several quickly growing markets like equipment for data centers, industrial automation, or infrastructure development for renewables. Today, I want to see if they are also a good long-term investment. And for that, I'll have a look at the business models and the markets, analyze their MOAT, and have a look at the latest financial statements. I'll also check the valuation to see if now is a good time to buy. So, sit back, relax, and let's explore Schneider's investment potential together. I am Florian. Welcome to Cashflow Maniac. The ticker symbol of Schneider is SU, and they are listed in the Euronext stock exchange in Paris. They are working in the industrial sector and were founded 1837. They have around 166,000 employees at the moment, and the headquarter is in this small town near Paris. Their market cap sits at $136 billion at the moment. Schneider Electric is a global company that few people know of, despite them operating in several quickly growing markets and helping to power the infrastructure change to renewable energy sources and the data center buildup for AI and cloud computing. They have a long history and were founded almost 200 years ago during the first industrial revolution. Over the centuries, they could reinvent themselves a couple of times, and today they specialize in energy management, industrial automation solutions, and products for digital transformation for homes, data centers, and infrastructure. They are either market leader or one of the top players in their segments. Their goal is to make energy use more efficient and sustainable. In fact, they are playing a key role in the transition to greener energy and the digitalization of industries. This is especially important with their modular products for data centers as well as soft and hardware for energy management. And the Time magazine and Statista even crowned them as the world's most sustainable company in June this year. I think one of the reasons they are not so well known is that they have a huge portfolio of many different products and services. So before we dive into the financials of the company, we first need to understand what exactly they are doing. As I mentioned, the company offers products for 4 different end markets: buildings, data centers and networks, infrastructure, and industry. According to the annual report from 2023, the share of these markets is 21% in data centers and networks, which is also the fastest growing market. 32% of the orders were generated in the buildings market, 34% in industry, and the remaining 13% in the infrastructure market. Schneider expects all markets to grow with a medium to high single-digit rate, except the data center market, which they expect to grow even with a low double-digit rate. What's also remarkable is that, at least according to the company's own numbers, they are market leaders in each of these markets and provide products from all 3 of the business segments to serve these markets. These 3 segments are products, which make up 52% of their revenue, systems with 30%, and software and services with 18%. And especially the systems segment is growing very quickly with 16% in only the last quarter, mainly because of the huge demand for energy management products in the data center and infrastructure market. For this, Schneider is even investing in additional production capacities to support its medium-term growth. And this is important because there are several problems in the energy sector that they can tackle with their products, namely the loss in energy power systems and the outages and interruptions in the US that cost the government $150 billion. But they also provide several operations and analytics software that allow real-time monitoring of power systems and use this data to become more energy efficient. On a geographic level, the revenue of the company is generated quite evenly across the world. The most important area is North America with 37% of their revenue. followed by 28 in Asia Pacific and 23 in Western Europe, which is their home market. The remaining 12% are earned in the rest of the world. The concrete products they offer are so diverse and vast that it would be too much to go over it in detail in this video. I can already see the retention dropping every time I do this. But I still think that it's important, and even more so if it's not so easy to understand. So I want to give you at least a brief overview. So the products range from low voltage products like circuit breakers, fuse switches and even cable management systems that you might also know from your home, to motors and drive controllers for industrial robots. They also offer rack-ready modular structures for all IT infrastructure necessary for data centers. With these modular designs, it is easy to adapt these systems to their customer needs. For example, by integrating different power configurations or cooling solutions that the company of course also provides. But as we saw before with their segments, they also use this expertise from their hardware business to offer integrated software solutions to improve the power grid reliability and efficiency, and even help with the planning of data centers or power infrastructure by providing digital twins, not only for the hardware, but also for the processes involved. They sum this up in their so-called digital flywheel that represents more than half of their revenue and integrates products, softwares and services from all of their segments by providing a high connectability between all of them. They are also in the process of switching their software services from a license-based model to a subscription-based one, and on further connecting all of their products. Earlier this year, they announced a partnership with NVIDIA to create a reference design for data centers that includes facility power and cooling, as well as the IT infrastructure and even the lifecycle monitoring software. This reference design will help the customers to quickly plan a new data center or retrofit older ones. I think that this partnership shows more than anything that they are seen as one of the industry's powerhouses and have a good chance of benefiting from the ongoing trends to cloud computing, AI and digital transformation. And speaking of ongoing trends, while the data center expansion in the US is already going on in full force, the rest of the world is just starting up, according to McKinsey. The global market for data centers is expected to grow with a CAGR of almost 12% until 2034. The biggest segment in this growth was actually the solution segment that made up 68% in 2023. So Schneider is in a prime position to benefit. But they are not only operating in the data center market. Many of their products are also used in IoT, the Internet of Things, and the Industry 4.0 market. Here, the expected growth is even higher with around 12% to almost 19%, as shown here from Markets and Markets. And as we saw before, Schneider is market leader in most, if not all of the segments they are operating in. This gives them a very strong position and helps them to fend off their competitors, even though the competitive rivalry from other global players like Siemens, Honeywell or General Electric is quite high. Their integrated and interconnected products make it very hard for their customers to replace them. Over the years, they have also gathered significant technical know-how, and this, together with the high capital requirements and good customer relationships, gives them a significant moat. And this moat has actually helped the company to grow the fundamentals significantly in the past. But I'm getting ahead of myself here. Before we jump into the fundamentals, let's first see how the stock performed against the S&P 500. Over the last year, Schneider could almost double the already great performance of the S&P 500 with a total return of 47%. Over the last 5 years, they could even more than double the performance of the index with 214%, and over the last 10 years, while not doubling, they still had an outperformance with around 300% total returns. This great stock performance is based on very solid fundamentals that show every sign of a great compounder. And please note, as a European company, the currency here is shown in euro, not in US dollar. In my analysis dashboard and trading view, we see that all metrics show a very nice and stable growth without much fluctuation. This is exactly what I like to see for my investments. I don't like large fluctuations or cyclicality in general. what I'm always looking out for are these stable and predictable uptrends, as we can see here across the board, even with the margins on the left side. In the last 5 years, the company could grow their revenue with a CAGR of 6.5%, which barely fulfills my criteria for this of 6%. The net income could grow with almost 11% though, and the free cash flow, my most important metric, with over 17% even. So the company is a real cash flow machine, and we also see this in the free cash flow yield. They could also grow their EPS with 10.6%. These values are all very good and above the thresholds that I have for my investments. And this growth also continued over the last year, and the last quarterly report shows a strong year-over-year growth in the first half year of 2024. What is also interesting to see here is that the organic growth, which eliminates any currency effects, is even higher compared to the actual results that also include currency effects. This was mostly due to the weaker Chinese yuan and several high inflation economies against the euro. Profitability-wise, their free cash flow yield sits at a very nice 3.3%, EBITDA margin at 20.6% and net margin of 11.2%. These values are all higher than their 5-year averages, which again shows that the company was able to increase their margins across the board. They are also sitting quite a bit above the sector medians, which proves that the company does have a moat against their competitors. The company also has a very healthy balance sheet and in the last quarter got even an upgrade for their credit rating from S&P Global to A-1. This also shows in the low long-term debt to EBITDA ratio of only 1.6 times, which is well below my threshold of 3 times. Unfortunately, the company is not buying back many shares, which resulted in a share dilution of 0.36% over the last 5 years, which is not great, but also nothing to worry about. In my opinion, these values make the EPS growth even more impressive, as they could achieve this with their operations only. Just imagine what would happen if they start buying back shares now. In fact, while the company reserves itself the possibility of share buybacks, their priority for capital allocation is much more on retaining a strong balance sheet, growing their dividends, and strategic acquisition. In fact, just a couple of weeks ago, by end of July, they signed an agreement with the workplace management software provider Planon to increase the ownership in the company from 20% to 80% and thus further strengthen their footprint in the global buildings market. And while Planon might be the most noteworthy acquisition right now, I mentioned in the intro that the company could reinvent themselves a couple of times already. And in the annual reports, we can find a whole list of acquisitions as well as divestments. I don't like companies too much that grow mainly through acquisitions like Broadcom, for example. But in this case, the company seems to be very careful and strategic with their approach. They are also not afraid to get rid of parts of their company that don't fit their business model anymore. So I'm not too worried here. The company is paying a dividend of 1.5% annually, and they could grow this dividend with 7.5% over the last 5 years. And while not huge, this is still a nice and stable value, and the growth has actually steadily increased over the last years. And they managed this while also keeping the cash flow payout ratio at a low 35%. One thing to mention here is that, as usual with many European companies, they are not so keen on increasing the dividend every year, regardless of their operations, like US companies usually do. So, even though the overall growth looks nice, there can be years where the dividend is not increased or even decreased a bit, like in 2017 or 2022, for example. But past performance is no indication for future returns, so let's see what analysts expect of the company in the next years. The average price target for 1 year based on 20 analyst ratings is just a bit higher than today, with an upside of only 3%. The maximum downside is with almost 25% quite a bit higher than the upside potential of 19%. They also expect an EPS growth of 10.5% annually until 2027 and a revenue growth of 5.8%. These values are not so far off from the growth values of the last 5 years, so it seems like the stable and predictable growth will continue. But the low price target seems to indicate that the stock might be a bit expensive right now. And indeed, the valuation of Schneider sits quite a bit above their own 5-year averages and also above the sector median. They currently have a PE ratio of 33.2, an EV to EBITDA ratio of 20 and a price to cash flow multiple of over 21. So last but not least, let's see how Schneider directly compares with some of their competitors. And for my peer comparison, I choose ABB, Emerson Electric, Siemens, Honeywell and GE. From this peer group, Schneider had the best performance over the last 10 years with quite some margin. The only company that comes close here is ABB with around 50% lower returns compared to Schneider. For investors that only look for a high dividend yield, it might still be not the right choice as they have the second lowest yield from our group. They do show the highest dividend growth on a 5-year basis though. And as we just saw, the valuation of the company is quite high, but even though there are still 2 companies with a higher price to earnings and price to cash flow multiples in this group, namely GE and Emerson. But only GE has a higher valuation in terms of EV to EBITDA. This valuation can be explained with the growth that is also one of the highest of this group. And the longer the time frame we use for our comparison, the better Schneider looks compared to their peers. What really stands out to me here is the free cash flow growth, where only Honeywell comes even remotely close to the company. Before we sum this up, if you found the video interesting, please hit the like button and subscribe to the channel so you don't miss out on my next video. As a quite small channel, this really helps me out a lot by pushing the video to a larger audience. So thank you a lot. But now, back to the question, is Schneider Electric a good long-term investment or not? I think that the company has a lot going for it. At first, they have been operating for almost 200 years now and have proven that they can adapt to different technological developments and reinvent themselves. They have also survived through many different economic environments, which again proves their resilience. And while they might not be the quickest growing company out there, they still grow at a decent rate which can beat at least my thresholds for my investments across the board. I also think that they have a decent moat which helps them to fend off their competitors. And the markets they are operating in all have significant secular tailwinds in their backs. For investors looking for a high dividend yield, the company might not be the right choice though, with a dividend yield of only 1.5%. But the decent dividend growth and low payout ratio still make it worthwhile in my opinion. Only the high valuation increases the downside risks at the moment. Overall, I still think that Schneider is a great investment. And if you have been following the channel for a while, you might know that I am actively looking for an industrial company to add to my portfolio. And while I have not pulled the trigger on Schneider yet, they are on top of my watch list now. I would love the valuation to come down a bit though. But please, before investing, do your own research and only use this video as a starting point for your own analysis. Unfortunately, many of such large and mega cap stocks are quite expensive right now. Therefore, I just launched my new series Small Cap Sunday with a video of a very unique renewable energy company that I actually own myself and of which analysts believe that it could more than double its stock price in the next year alone. If this sounds interesting to you, you should check out this video. That being said, thank you so much for watching guys, and see you in the next video.